So recently I read an article talking about share buybacks. Actually, I'm going to show you guys the article that I actually read. It's this article on Axios, and it talks about the buybacks are coming. It says in the article, it was expected that with the economy improving and company balance sheets already loaded with cash, U.S. firms would slow down their debt issuance in 2021 after setting records in 2020. But just the opposite has happened. Companies generally issue bonds for one of two reasons: because they're worried about not having enough cash, which is why they issued a lot of debt last year, to cover their expenses, or because they want to lever up and make risky bets. Since U.S. companies currently are holding record amounts of cash, now looks to be an example of the latter. Buybacks slowed down during the pandemic as companies shifted to shore up their cash positions, but rather than deploying that cash, companies are instead getting more of it via bond sales and using that cash to buy back their stock. The boom in bond issuance and buybacks is the latest example of how the Fed's policy are underpinning and perpetuating economic inequality and the K-shaped recovery. The Fed lowered interest rates so companies can borrow money cheaply, but that borrowed money isn't used to invest in raises for employees or hiring new workers. It's used to buy back stock to enrich C-suite executives and stockholders. Case in point, last month's non-farm payroll report showed leisure and hospitality, government, and business services, three sectors where companies are minimally players in private debt markets, added more than half of the jobs. While financial services, utilities, and information, all sectors with a major presence in debt issuance, were the three lowest sectors for job creation, adding 13,700 jobs during the same time period. So in this video, we're going to talk about why I despise stock buybacks, which a lot of people are going to be like, what? But let's talk about why, okay? Whoosh. What's going on, people? It's your boy Kelechi, back with another video. If this is your first time on these parts, hit that subscribe button. If you enjoy anything that I talk about on this video, hit that like button. Turn that thing, say with me now, blue. But in this video, we're going to be talking about share buybacks and why I despise them and why I don't like the mentality of share buybacks, or why I don't like the way that they're currently being used by so many companies. First of all, let's get into what exactly is share buybacks. According to Investopedia, which is my favorite site to go on whenever I'm trying to learn anything new, it says that a share repurchase, which is the same as share buyback, is a transaction whereby a company buys back its own shares from the marketplace. A company might buy back its shares because management considers them, keyword, undervalued. The company buys shares directly from the market or offers it to shareholders option of tendering their shares directly to the company at a fixed price. It is also known as share buybacks. This action reduces the number of outstanding shares, which increases both the demand for the shares and the price of the share. We go back to one of the key points it made. It said, when a company considers them undervalued, that's when they're supposed to be doing share buybacks. When a company sees the price of its shares, and it understands that, our company is way better, so we're gonna buy back our shares. We're gonna actually own more of our shares because the rest of the world does not see the things that we see, because we are insiders and we understand what's going on. It's a way to announce to the world that, hey, we think our company is doing really, really well right now. Although you guys may not be seeing that, we think we're doing really well right now. We're actually going to buy back more of our shares and take ownership back because we believe we are on the verge of doing something great. That's what it used to show. Now it's just a manipulation technique. Now it's just a financial trick. Now it's just basically a company's management uses it as a way to boost the share price. It no longer sends the same signal. It no longer sends the signal that, hey, guys, we think our share is undervalued. We believe that what we're working on that you may not know of yet is going to do something amazing. That's no longer what it does. Now they're just playing with the metrics of supply and demand. That's all that is going on, because as you guys know, and as I know, and as we've learned during the COVID-19 pandemic, through when oil became so cheap last year because nobody was going anywhere. So demand was completely obliterated. So much so that oil prices went negative at one point. We talked about it on my podcast. If you don't know what I'm talking about, go check out the podcast. It's called the Rambling Mind Podcast. Link down in the description. But it was something that we had never seen before. Why? Demand was completely obliterated. So oil became super cheap. That's the same thing that a lot of company managements are doing nowadays. All they're doing is manipulating the number of shares outstanding. All they're doing is spending money to buy those shares back. Not because they believe that the company is undervalued, just because it's an easy way for them to boost the share price. Let's go back into the article real quick and take a quote, read back one of the quotes that it said in there. It said, this boom in the bond issuance and buyback is the latest example of how the Fed's policies are underpinning and perpetuating economic inequality and the K-shaped recovery. What is the K-shaped recovery? The K-shaped recovery is when those who already have keep getting more and more wealth, and those who don't have keep getting nothing and more nothing. And that's just being perpetuated more and more. So it says the Fed's lowers interest rates so companies can borrow money cheaply, but that borrowed money isn't used to invest in raises for employees or hiring new workers. It's used to buy back stock to enrich C-suite executives and stock shareholders. As a case in point, the people who have issued the most bonds, which for a company, this is how they get debt. This is how they don't just go to a bank like you and I do to get a loan or anything. What companies do is they issue a bond. A bond is a way of like, hey, I owe you money, give us some money, and we'll pay you a certain percentage back over time. And that's what a bond is. And the companies that have issued the most amount of debt are the companies that have brought in the least amount of people in the last couple of months, as we've been seeing this major hiring freeze. Now, at the same time, people want to say, well, there's not that many skilled people that can work in financial services or utilities or information technology and all this other stuff. That's a fair point. But there are other things that these managers can do to boost the company, to invest in the company. There are so many other things that a company can do rather than just buying back their shares all the time. Like, I don't understand this. Like, I understand the idea that a share buyback is much cheaper than hiring people, because hiring people is a consistent number that's going to be on the balance sheet. It's a consistent cost. I understand that. It's not that I don't understand it. But at this point, share buybacks are something that are happening every single year. How can your stock be undervalued every single year? It's no longer an argument of saying like, oh, it's cheaper for us to do it this way because this is the best way for us to be able to spend this money at this point in time. It's becoming just a balance sheet line item number. I'm seeing it all the time on companies that I look into. It's no longer just like, oh, this is a special one-time event that we're going to use our money to spend on because we believe it's an appropriate use of capital. No. This is becoming a cost factor that businesses have to just do it. Like most every business is just doing it. They're just like, oh, we're just going to buy some shares back. Even if we have to take on more debt to do it. Let's go back to the article one more time. It says that over $157 billion of debt was issued in the first quarter alone. In the first quarter. So my point is, and my main argument against this whole buyback theory is it's no longer used as an indication of like a company is saying, oh, okay, we believe our share is cheap. All I'm seeing now is a lot of companies that are issuing share buybacks just to boost their stock. They use it as a financial trick to boost their stock, and then to use it as a way to show like, oh, our stock went up, and so we can get compensated for it. There's a reason why Warren Buffett prefers dividends. And some people will be like, oh, but you know, the tax implications of dividends are terrible. I have to pay tax. It's way better off to pay me a dividend than for you to keep doing this financial metrics. The best thing they're supposed to be doing with this money is to figure out ways to invest it back in the business to grow. We've seen this metric. We've seen share buybacks play a detrimental way in how some companies have fallen. For example, IBM. For years, IBM kept on doing share buybacks to boost the stock price. Did share buybacks, boosted its stock price. But then it wasn't innovating. It wasn't doing anything. It kept on falling behind in innovations. Now what is IBM? Once upon a time, it was the jewel on the hill for American companies. Now it's not even a shiny spoon. Now it's not even a stainless spoon that we want to use and only bring out when we have guests. It's not even that. It's the one that is in the crevices of the corners of our drawers that we're like, it's in there, but we don't really like to use it that much. I mean, now it's turning around, but the point still remains that IBM that could have used that money to invest back into the business and made it something to be something powerful. Thank God they have a new leader that's pushing the edges and doing good things now. The same thing was about to happen to Intel, where the CEO was more focused on doing share buybacks than actually innovating. That's why Intel now, we have AMD and Nvidia that have completely taken past Intel and are doing great things. Good thing that CEO is out of there, and we actually have somebody in there that's actually going to push the envelope so they can innovate more rather than doing share buybacks to boost the stock price. So yeah, my point is, I don't like share buybacks because lately they've been used to do nonsense. They've not been used properly. Not every company should be doing share buybacks. There's literally like a handful of companies that I can see who have so much money that when they say we're doing share buybacks, I'm like, I understand. For example, Apple and Microsoft and Google and Facebook or any of these companies. Why? Because they have hundreds of billions of dollars just sitting, and there's only so many companies they can buy or so many things they can innovate on. And so when they do share buybacks, I'm like, you know what? I understand. But for a bunch of these other companies that don't have the same balance sheet, that don't have the same cash on hand, I don't see why they're doing share buybacks. I just don't see it. So to close this thing out, I'm going to say this. Share buybacks in and of itself are not evil. They're not evil. And share buybacks and dividends are not the same thing, because I've seen a lot of people put them together. They're not the same thing. However, it all comes down to the management team. This is why we talk about the management team of the businesses that we're investing in. Very important. How are they using those share buybacks? Are they just using it so that they can get their bonuses, or are they using it so they can grow the business? Because short-term thinking does not help us long-term investors. It does not help us out. It also does not help the companies. It does not help the employees in any shape or form. All it does is line the pockets of those in the C-suite so they can get their bonuses. But that's just me. That's just me. That's what I think about share buybacks. Let me know down in the comments if I'm being dumb, if I don't understand finances, or if I don't understand any of the things that I just mentioned in this podcast. Let me know down below, because there's a lot more smarter people out there than I am. But anyway, that's all I got for y'all. I hope you learned one, maybe two things out of this entire thing. And if you did, hit that like button. If you loved it, hit that subscribe button. But I'm gonna catch y'all up on the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all. And I'll catch you later. Peace.